Mastering the art of emotionally intelligent investing. How to set and stick to your plan. Are you tired of making impulsive decisions in the stock market that will leave you feeling like you've been taken for a ride? Well, it's time to unlock the secrets of investing through emotional intelligence. Welcome to our YouTube video on how emotional intelligence can help you make better investment decisions. In this video, we'll explore the link between emotional intelligence and investing success and provide some practical tips on improving your emotional intelligence and making smarter investment decisions. So, stick around till the end of the video and don't skip because we will explain everything in detail. What is emotional intelligence in investing? Emotional intelligence involves recognizing and managing one's own and others' feelings to make better business choices. In terms of investing, it requires knowing how feelings affect financial choices and learning how to manage and minimize them. Emotions influence business choices. Fear, greed, and worry can cloud investors' judgment and cause rash choices. However, greed can lead investors to take undue risks for fast gains. Investors must comprehend how emotions impact business choices. Investors can make more logical, long-term financial choices by understanding and managing their feelings. Emotional intelligence helps managers avoid making bad decisions, spread resources, and focus on long-term plans. For example, emotional intelligence can help an investor remain calm during market volatility. Instead of panicking and selling all of their investments, an emotionally intelligent investor would recognize the emotional turmoil they are experiencing and make decisions aligned with their long-term investment goals. They may choose to diversify their portfolio or adjust their investment strategy, but they would not make hasty decisions based solely on their emotions. Another example of how emotional intelligence can help investors is in risk management. An emotionally intelligent investor would recognize risk tolerance and avoid investments outside their comfort zone. This can help them avoid the emotional stress of high-risk investments, leading to impulsive decisions and poor investment outcomes. Overall, emotional intelligence in investing is recognizing and managing emotions to make better investment decisions. By understanding how emotions affect investment decisions and developing emotional intelligence, investors can make more rational decisions aligned with their long-term investment goals. The impact of emotions on investing. Emotions can greatly impact investment decisions and lead to biased decisions and irrational behavior. Fear, greed, and overconfidence are common emotions that can cause investors to make poor investment decisions. Fear can cause investors to sell off their investment during market downturns, leading to losses. This can result in missed opportunities for gains when the market recovers. For example, Carl Icahn, the billionaire activist investor, is known for his aggressive tactics in pushing changes at companies in which he holds stakes. However, his emotions have also led to some missteps, such as when he sold his entire stake in Apple in 2016, citing concerns about the company's growth prospects. Apple's stock price has since surged, leading some to criticize Icahn's decision as driven by emotion rather than sound investment strategy. Warren Buffett, the billionaire investor and CEO of Berkshire Hathaway, is known for his disciplined approach to investing and focus on long-term value creation. Buffett has also acknowledged the role of emotions in investing, stating that fear and greed can lead investors to make poor decisions. In 2008, during the financial crisis, Buffett famously advised investors to be fearful when others are greedy and greedy when others are fearful, highlighting the importance of emotional regulation in making sound investment decisions. Being emotionally intelligent has huge positive impacts. Buffett's ability to control his own emotions has given him a big leg up when it comes to sensing and reacting to the feelings of others, including executives and employees of the businesses in which he invests. Buffett has found cheap companies that are likely to grow and be successful because he deeply understands how people act and what makes them take certain business decisions. These examples demonstrate how impulsive decisions can lead to significant financial losses, particularly during periods of market volatility. By deviating from long-term investment plan and making short-term decisions based on emotions, investors can miss out on potential gains and lock in significant losses. Here are some examples of the effects of being emotionally unstable in investing, along with real-world examples of how much people have lost. Panic selling. When the stock market experiences a significant decline, some investors panic and sell their investments in a hurry to avoid further losses. However, this can lock in losses and prevent investors from participating in any potential market rebounds. For example, during the 2008 financial crisis, investors who sold all of their investments at the bottom of the market lost significant amounts of money. For instance, a person who invested $100,000 in the S&P 500 index in January 2008 and sold it in March 2009 would have lost $34,000, whereas an investor who stayed invested during the same period of time would have gained $20,000. 2. Chasing hot stocks. Some investors become overly focused on short-term trends and invest in stocks that have recently performed well, hoping to benefit from further gains. However, this strategy can backfire if the stocks decline in value. For example, in 2017, Bitcoin was a hot investment and saw tremendous gains. Many investors chased the trend and invested heavily in Bitcoin. However, in 2018, Bitcoin's value plummeted, and investors who had invested heavily in the cryptocurrency suffered significant losses. 3. Allowing emotions to guide investment decisions. Emotional decisions can cause investors to deviate from their long-term investment plans and make short-term decisions based on emotions rather than logic. For instance, investors may buy a stock based on a hot tip from a friend or colleague without conducting proper research. In 2019, a prominent investor tweeted that he was shorting Tesla, causing the stock to decline in value. Many investors panicked and sold their Tesla shares, resulting in significant losses. However, investors who had conducted proper research and believed in the company's long-term prospects did not sell their shares and were able to benefit from the stock's subsequent gains. Investors who fail to adopt emotionally intelligent strategies are at risk for making impulsive decisions based on fear, greed, and panic. These emotions can cause investors to abandon their long-term investment plans, resulting in significant losses and missed opportunities. For example, during the 2008 financial crisis, investors who panicked and sold their investments at the bottom of the market lost billions of dollars in value. Many of these investors never fully recovered from their losses and had to delay retirement or cut back on their financial goals. The traits of emotionally intelligent investors. The key traits of emotionally intelligent investors include the following. 1. Self-awareness. Emotionally intelligent investors know their emotions, triggers, and biases. They understand their strengths and limitations and can regulate their emotional responses to market volatility and uncertainty. 2. Empathy. These investors can understand and share the feelings of others, including market participants, stakeholders, and companies. They can put themselves in other people's shoes and consider the perspectives of different stakeholders. 3. Discipline. Emotionally intelligent investors have the discipline to follow their investment strategy, plan, and rules. They are not swayed by short-term market trends or impulses and can maintain a long-term perspective. 4. Resilience. These investors can bounce back from setbacks, failures, and losses. They can learn from their mistakes, adapt to changing market conditions, and stay committed to their goals. 5. Curiosity. Emotionally intelligent investors are curious and open-minded. They seek out new information, perspectives, and insights and are willing to challenge their assumptions and beliefs. These traits are important because they can help investors make better decisions by reducing the influence of emotions, biases, and cognitive errors. By being self-aware, investors can identify when they are being driven by fear, greed, or other emotions and can take steps to counteract them. By being empathetic, investors can understand the motivations and interests of other stakeholders and make decisions that align with their values and goals. By being disciplined, investors can stick to their plans, avoid impulsive decisions, and avoid costly mistakes. By being resilient, investors can bounce back from their setbacks and stay focused on their long-term objectives. Finally, by curiosity, investors can seek new opportunities and insights that lead to better investment decisions. Successful investors who exemplify these traits include Warren Buffett, Charlie Munger, and Ray Dalio. Buffett and Munger are known for their self-awareness, discipline, and curiosity, while Dalio is known for his empathy, resilience, and willingness to learn from his mistakes. All three investors have achieved long-term success by following a rational, disciplined, and patient investment approach grounded in their emotional intelligence. Strategies for developing emotional intelligence in investing. Here are some practical tips for developing emotional intelligence as an investor. 1. Practice mindfulness. Mindfulness is the practice of being fully present in the moment and aware of your thoughts and emotions. By practicing mindfulness, you can become more aware of your emotional triggers and learn to regulate your responses to market fluctuations. This can help you make more rational investment decisions. 2. Seek diverse perspectives. Seeking diverse perspectives can help you develop empathy and understand the motivations and interests of different stakeholders. You can do this by reading diverse news and analysis resources, attending industry events, and engaging with a diverse group of peers and experts. 3. Analyze past mistakes. Analyzing investment mistakes can help you learn from your failures and develop resilience. This can involve journaling your investment decisions, seeking feedback from others, and reflecting on your decision-making process. 4. Practice disciplined decision-making. Developing discipline is key to emotional intelligence as an investor. You can practice disciplined decision-making by sticking to your investment plan, avoiding impulsive decisions, and focusing on your long-term goals. 5. Set goals. It's important to have realistic goals for your investments. Setting goals can help you make informed decisions about how much risk to take on. Do you want to save for retirement, a down payment on a house, or your child's education? Knowing what you're working towards can help you determine how much you need to invest and how long you have to reach your goals. If your goals are short-term, you may want to focus on more conservative investments. If you have a longer investment horizon, you may be able to take on more risk. 6. Manage risk. Managing risk is a critical part of investing. While it's impossible to eliminate all risk, there are several strategies that investors can use to manage it. One of the most effective ways to manage risk is to diversify your portfolio. This means investing in a variety of assets across different industries and sectors. By diversifying, you can reduce the impact of a single stock or industry on your overall portfolio. It's important to know your risk tolerance and invest accordingly. If you're not comfortable with a high level of risk, you may want to stick to more conservative investments. If you're not confident in your ability to manage risk, consider seeking professional advice from a financial advisor or investment manager. They can help you develop a risk management strategy that is tailored to fit your individual needs. Remember that risk is a natural part of investing, but it can be managed to help you achieve your financial goals. Improving emotional intelligence takes time and effort, but can be done with practice. By consciously working to develop these traits, investors can become more effective and successful in their investment decisions. Over time, emotional intelligence can become ingrained in an investor's decision-making process, leading to better outcomes and a more satisfying investment experience. There are many resources and tools available to help investors develop emotional intelligence. These can include books, online courses, coaching programs, and support groups. Some popular resources for developing emotional intelligence and investing include The Intelligent Investor by Benjamin Graham, Thinking Fast and Slow by Daniel Kahneman, and the Behavioral Investor podcast by Daniel Crosby. The role of emotional intelligence in long-term investing. Emotional intelligence plays a crucial role in long-term investing. Investors with emotional intelligence are better equipped to stay the course during market downturns and achieve long-term goals. Here are some examples of how emotional intelligence can help investors succeed over the long term. 1. Staying disciplined. Emotional intelligence helps investors stay disciplined and avoid making impulsive decisions during market fluctuations. This means adhering to a long-term investment strategy and avoiding the temptation to buy or sell based on short-term market trends. 2. Being patient. Emotional intelligence helps investors be patient and stick to their long-term investment goals. This means resisting the urge to react to short-term market volatility, instead focusing on the long-term outlook for their investments. 3. Maintaining a long-term perspective. Emotionally intelligent investors can maintain a long-term perspective despite short-term market fluctuations. This means recognizing that markets are inherently volatile and understanding that a long-term investment strategy is the best way to achieve sustainable returns. Warren Buffett, widely regarded as one of the greatest investors of all time, has achieved an average annual return of 20.3% over the past 56 years through his investment company, Berkshire Hathaway. This impressive track record is a testament to Buffett's disciplined approach to investing, which emphasizes thorough research, a long-term perspective, and a focus on high-quality companies with strong fundamentals. Sir John Templeton, another highly successful investor, achieved an average annual return of 15% over a 38-year period through his investment firm Templeton Growth Fund. Templeton's approach to investing also emphasized a long-term perspective and a focus on undervalued companies with strong growth potential. His success is a testament to the beliefs of adopting a disciplined and rational approach to investing rather than giving in to emotional impulses. We hope this video helped you understand emotional intelligence's importance in investing. In short, emotional intelligence is the ability to recognize and control your feelings and to understand and care about the feelings of others. Emotionally intelligent investors know themselves, care about others, and have self-control. This helps them make better financial decisions and reach their long-term goals. As an investor, you should be more aware, find different points of view, learn from your mistakes, and make decisions with discipline. With practice, you can improve your emotional intelligence and use it in your investing. Subscribe to this channel and press the bell icon to watch more informative content. Thank you again for watching. We welcome your thoughts and questions in the comments section below. This content is for educational and entertainment purposes only. We do not provide investment advice. It is just for imparting finance-related education to viewers. The information is being presented after thorough research on the internet and might only be suitable for some investors. Past performance is not indicative for future results. All investing involves risk, including the possible loss principle.